The analysis that the uptrend was remaining in progress is much more clearly illustrated when you're looking at the candlestick chart that is showing indecisive and then bullish positions or bullish trading at the T-line area. So when we saw the pullback in the Dow reach the T-line and then the next day open positive and trade positive, it was that much more evident that the uptrend was going to remain in progress. Now there's a long-term evaluation where the breakout of this level, which is the all-time highs for the market, with a kind of a J-hook slow curve pattern, tells us the bullish sentiment is still there. We could be now heading into a wave 3 for a much stronger market trajectory. When you go to the long-term chart, notice we had a big strong move during this time frame, and then for the last 18 months we've basically moved sideways, with the markets just about ready to break out into new territory, coming out of a J-hook pattern, implying there's going to be more upside, which tells us we might now be in wave 1, wave 2, going into wave 3. This does not necessarily mean you want to listen to people that just say, oh, we're going into an upward strong market. We can analyze that much more clearly by what type of signals and patterns are being created right here at a breakout level, that if we do break out through this area, wave 3 could now be a good prospect. The longer term chart on the Nasdaq also producing a J-hook pattern, that if this wave right here and this wave right here are the same, it's well implied that it's going to break out through this level. The common sense that is built into candlestick analysis also makes the evaluation of a trend movement that much more easily to assess. For example, the bullish engulfing signal in the Nasdaq off the T-line, and the fact that the next day they gapped it up going into this resistance level. Common sense says if they're buying strong, knowing that this could be your resistance level, they're probably not buying with so much strength that they don't anticipate that this level is not going to act as a resistance anymore. You're not going to see them do a buy signal and then gap up to the level that could be a resistance unless they were planning to see much higher prices. If this is the case, this allows the candlestick investor to take advantage of a lot more high profit patterns without the fear of a trend reversal in the immediate future. Our recommendation on MDR was based upon a bobble breakout situation. There was our left-right combo, a very strong buy signal, right at the resistance level, that if they opened up positive, what'd that tell us about our resistance level? It wasn't going to act as resistance. That creates new investor sentiment coming into a trade. We can just be prepared visually to see that setting up. Bobble breakouts produce very high probability, high profit trade. Our recommendation on STON, Stone Company, was based upon a fry pan bottom breakout, putting us into a new category and telling us that our next target was likely coming up here to fill this gap. This is not rocket science. This is merely identifying new strength coming into a pattern breakout, telling us the probabilities are pretty strong that investor sentiment has changed dramatically, that we're in now a very profitable trade setup. Putting yourself into positions that we know what the results are, such as a fry pan bottom breakout, a J-hook pattern breakout, scoop patterns, cradle patterns, are all patterns developed by human nature that not only produce high probability results, but usually produce very high profit results. That'll be it. We'll see you in the chat rooms.